Hey guys, welcome to the video. Let's talk today about the FHSA, the First Home Savings Account. This account was actually first introduced in 2023, and it was very exciting when it came out because it's the first time that the government has allowed Canadians to get tax deductions and also tax-free withdrawals with no strings attached. Well, almost no strings attached. So the FHSA came out April 1st, 2023, and at this point, almost all institutions that offer accounts are offering this account to be used. So how it works is similar to the RRSP. When you contribute into the FHSA, you're going to get a full tax deduction. So every dollar that you put in is fully tax deductible, and it works the same way as the RRSP does. I made a separate video explaining the mechanism on how RRSPs work in terms of your income. So if you haven't seen that yet, I suggest you hop over to that video and you give it a watch. So the FHSA combines those tax deductions of the RRSP with the tax-free withdrawals of the TFSA, which is what makes it such a powerful tool. The FHSA was created by the government as an incentive to help Canadians save more money for their first home purchase and make it easier to get into the market. Although we've seen rising house prices and many other challenges for young Canadians, it is a good thing to have, and it does make it a lot easier when we have more tax deductions. And guess what? Even if you're not planning to buy a home, the FHSA could still be a very powerful financial tool. More on that later. Now, who can open up an FHSA? So Canadians age 18 to 71 can open an FHSA so as long as they qualify as a first-time homebuyer. What qualifies someone as a first-time homebuyer? Well, if they have never bought a home or have not lived in or occupied a qualifying home in the last 4 years. That's right. If you bought a house previously and you moved out and rented that house for 4 years and you didn't live there, you could actually qualify as a first-time homebuyer, which is pretty cool. So you can definitely use it more than once if you became a first-time homebuyer a second time. You must be a resident of Canada as well, and there are annual contribution limits. So the annual contribution limit is fixed, just like the TFSA, but it stays at $8,000 per year until you reach the full $40,000 contribution limit. So for example, let's say John opens up a FHSA in 2025. He is able to put up to $8,000 into the account in that year. Soon as January 1st rolls around of 2026, he now has a limit of $16,000. So whatever he didn't put in 2025 will carry forward into 2026. Let's assume he put no money into it at all for the first 2 years. 2027 rolls around, John now has $24,000 of contribution room, and so on until he reaches the full $40,000 contribution limit. So this is actually important to know because if, let's say, you're a young person and you're not planning to buy a house for the next 5-10 years, you might want to open up an FHSA early so that you start accumulating that $8,000 annual contribution limit. Because if you don't open one up, you will not start that process of accumulating that annual amount. So make sure that you register one and you open it at the bank or financial institution or credit union prior to needing to put money in for those tax deductions. So let's give an example of using the tax deduction on an FHSA. Let's say John makes an income of $90,000 in British Columbia. His marginal tax rate would be 28.2%. If John decides to put $8,000 into his FHSA in the same year, he will get a 28.2% tax deduction on the $8,000, which gives him back a tax refund of $2,259 when he files his taxes the next year. Not to mention, he can take that extra $2,200 and put that into his own savings or his own investments. So that's extra money that we can use towards the down payment or towards our own investments. Now, let's say John continues to do that for 5 years, getting an $8,000 tax deduction each year. $2,256 times 5 years equals $11,280. So not only did John save $40,000 for his first home, he actually has an additional $11,200 or so to use towards that down payment. And not to mention, now that he takes the $40,000 out to buy the home, he does not pay any income taxes on the $40,000. And guess what? If his $40,000 was invested in an investment that grew to $50,000 in the FHSA, He can take all that money out completely tax-free because there's no withdrawal limit. There's only a limit on deposits. So you can't put more than $40,000 into the FHSA, but you can take more than $40,000 out. So the main difference between the RRSP homebuyers plan and the FHSA is that the FHSA does not need to be repaid at all, whereas the homebuyers plan has to be repaid within a 15-year time frame. So the nice thing is that not only can you get tax-free withdrawals from the FHSA, you can combine the FHSA with the RRSP homebuyers plan for up to $100,000 between both per person, per purchase for your contribution towards your down payment, which is an amazing, amazing benefit that you should definitely take advantage of so that you don't pay more in taxes. Now, what if you don't use the FHSA? What you can do is you can either transfer it to your RRSP or you can keep it for up to 15 years. So from the time you open up the account, you do have to take the money out within 15 years or transfer it over to the RRSP. Now you could also withdraw the money, but again, if it's not used towards that down payment, it's gonna be fully taxable because you got the tax deduction in the first place, so now you're gonna pay it back when you take it out. Now, similar to RRSPs and TFSAs, FHSA have an over-contribution penalty of 1% per month, so just make sure you don't over-contribute to it because that's gonna be a big burden for you as well. Now, what kind of investments can I hold within my FHSA? It's no different than any other account like your TFSA or your RRSP, but if you do plan to buy a house in the next 5 years, be very careful to not invest all your money into equities where the stock market could drop sharply and leave you at a downturn when you go to take that money out. If you're close to your goal of taking money for your down payment, pick a low volatility, low risk option. It's a much better choice when you're close to that timeline. Don't take unnecessary risk and don't gamble. One bonus tip I'll leave you with is if you don't actually plan to buy a home at any point, you can still use the FHSA if you've maxed out other vehicles like your RRSP and your TFSA because you're still considered a first-time home buyer, but then you could maybe defer it later to your RRSP when you get to that 15-year mark. But again, you want to make sure you're strategic so you don't end up over-contributing or getting taxed on that more later. Lots of high-income individuals do use this plan, but you have to be very careful with how you go about it. So all in all, it's a good idea to open an FHSA early if you think you may be a homeowner in the future. That way you can bank those extra tax deduction limits and you can use them in years where your income is much higher. Hope you enjoyed the video and we'll see you next week. Take care.